Hello, my name is Joshua Tagg. I'm a senior mortgage associate with Mortgages for Less. One of the first things to understand when you're preparing for a mortgage, especially if it's your first time, are what factors affect your approval. Now, there's dozens of things that can affect your approval, and each lender looks at things a little bit differently. But in most cases, most approvals come down to the three pillars of a mortgage approval. Simply put, the three pillars are your credit history, your down payment, and your income. Your credit history makes most of the yes or no decision on the application. You could earn hundreds of thousands of dollars a year, but if you don't pay your bills on time, most lenders will be quite reluctant to lend you money, especially at the lowest rates, or if your down payment is fairly small. When we look at a credit report, we look to see if there's enough credit established. Normally, as long as you have a full year of active credit established, that's sufficient. A few of the less common programs do require a longer credit history, however. Once we confirm that you have enough credit history, and that the credit history that you have indicates that you pay your bills on time and that you don't rely too much on your credit, then you're usually okay on that area. The next thing that we can look at is your down payment. Typically, the down payment needs to be 5% of the price of the home. It can be less, it can be more. Allowable sources of a down payment are savings, RSPs, or even gifts from immediate family members. Sometimes we're even able to use employer grants, borrowed funds, or a lender cashback, which allow you to get a zero-down mortgage. Cashback programs are a good way to purchase a home if you don't have enough of a down payment. With the high prices of homes in some of Alberta's more expensive markets, saving up a down payment can take a long time. Some of our lenders are happy to provide you with part or all of your down payment as long as the credit that you have is good enough. They charge a slightly higher rate on these programs to recover the amount of money that they gave you for your down payment. If your credit is tarnished or if your income is difficult to prove, you may need a larger down payment. The last pillar of a mortgage approval is your income. Where credit and down payment tell us if you can get a mortgage, your income primarily determines how much of a mortgage you can have. Most people's incomes fall into one of three areas: those with straightforward salaries or full-time hourly work, those who are paid commissions, or the last area is those who receive a notable part of their income through bonuses or overtime, or those who are self-employed or are contractors. If you're in the first category, your income's really easy. If you're in one of the other two categories, most lenders and banks need to see a 2-year history of your T4s or your NOAs, notices of assessment from Revenue Canada, in order to establish your income. Most lenders allow us to use up to 44% of your gross personal income to make the payments on your home, property taxes, utilities, and any other debts that you have outstanding. Limiting it to the 44% leaves you enough extra money that you can take care of your other monthly obligations such as fuel, food, children, entertainment, etc. So what really is the next step? Go ahead and complete our no-obligation mortgage application online at the website below, mortgagesforless.ca, or call to speak with one of the mortgage professionals in your city at one of the following numbers.